So I'm going to stick my neck out and make a case as to why buying Nike right now, just because the price went down, is not a good idea. So we're going to do a little experiment right now. Let me bring up my screen. This is a chart of Nike 2 years ago. Take a look at it, right? We see hitting a high here of 165. It's coming down to about $90, right? Sitting just above, right around the previous highs before COVID. It's starting to bounce here. Is this a great spot to be a buyer? You best believe a lot of retail was looking at this chart and saying, yeah, I mean, look at it. It's a triple bottom. And this is Nike we're talking about here. Of course, it looks like a great buy, right? At $87. At $87, right? I mean, it looks phenomenal. Let's put a marker there. And let's jump forward. What ends up happening? Right, from 87 down to $41. How about now? We're at $71 here. I mean, we broke down to 50, we climbed back up, we're hanging out here at $70, we've consolidated here before. I mean, this looks like a decent spot to go long. I mean, hell, listen, we're still down. How much are we down? We're still down 56% from the peak. This looks a great spot to go long, right? Let's mark this one out, right? This is the spot at $71. What happens? Oh, that's how the chart looks like there. Right, just keeps on selling off. How about right here? We're at $50. This is a double bottom. Nike is going to report earnings tomorrow. We're sitting at a double bottom. We're down. How much are we down now from the peak? We're down 70% from the peak. It's a double bottom. Earnings are tomorrow. This has to be the bottom, right? Okay, let's go forward. It's $50, $50.91. Nope, ends up gapping down. It ends up gapping down, right? And then here we are, right? We're doing this all over again. Everybody's looking at this chart. Quad bottom, whatever you might say. This might even be a false breakout, right? Some people might be looking at this right now and saying, listen, this is a false breakout. We're coming back into the channel. It might even be a false breakout. But the point I'm trying to drive here through those examples is buying a stock just because it's down a lot is not a reasonable investment thesis. That is not why you want to buy a stock, because it's gone down 50, 60, 70%. What it's been in the past has honestly no relevance to what it can do in the future, because the company that they were in the past is not the company they are today. The competitors that they had in the past are not the same competitors they have today or in the future. And more importantly, the consumers and the environment that existed in the past is not the same environment today or in the future. So looking at this and saying Nike is a buy because it traded at 165 in the past honestly has zero relevance for the future performance of this company. Let's continue our experiment. Here is Under Armour. This is also a household name. I think a lot of us might have bought Under Armour at one point or another, especially if you're into sports. This is how Under Armour looked until 2016. Phenomenal stock, right? Just printing up, up, and up and away. Okay. And then it begins to sell off. Okay. $21 in 2017. People can look at this and be like, Under Armour is down over half. Oh, it dropped by over half. They still sell in stores. They're still popular with athletes. Top-level athletes are still being sponsored by Under Armour. This is a no-brainer buy. Look what it did in the past. Look how high it went in the past. But if you fast forward and if that was your whole thesis, the fact that this is a household brand, the fact that athletes are still wearing this, the fact that you still see this in the streets, the fact that you still enjoy their clothing, if that was all of your thesis, and you were buying Under Armour 10 years ago nearly, you would be down 75% on your money, even after it went down this initial level, right? I mean, you'd be down, if you bought in at $20, you'd be down 75%, and this is after it collapsed. The stock is down 90% from its peak, okay? 90%. And there are still some shareholders out there, I guarantee, that are still back holding this all 5-6 years, looking at these peaks, thinking, oh, that can still happen. It can't happen because, again, the world has changed since Under Armour was dominating them 12 years ago. GoPro fits into that as well. they still dominate their niche till this day. Their products are still popular. They're still releasing new products till this day, which get great reviews that people do love. I own some GoPro products. Look at the stock. If you use their product, you think that it's all on the up and up. The stock is horrible. It's down, I mean, what is this, 99% from this level here? Same deal. You have retail investors looking at this when they were buying at $12, buying at $5, saying GoPro was worth $100 in the past. It's got to recover some of that. Absolutely not. Look what's going on with GoPro. And this is an example, by the way, of there being a separation between the stock and the company. A company can be doing well and the stock can be doing poorly. You also get vice versa. Sometimes you get a situation where the company is doing all right, but the stock is doing better than you would expect. You have to separate the two. And just because you see Nike still being worn, just because you see Nike stores still being full, does not necessarily mean that they are on the verge of a recovery or the fact that they will continue to withhold the levels that they've been holding all this time. Now, we're going to dive into the financials just a little bit, but I don't want to spend too much time on it for one simple reason. I do not personally believe that you can sit there, look at this public data that everyone has access to, and think that there's an edge to be taken from this and say, well, based on my model of this, my model of that, they can grow at a rate of 10% per year and their stock can go up this much. All of that, it doesn't make any sense to me because, again, everyone has access to that. Everyone has their own models. And a lot of that is simply based on so many assumptions, which you can never really put much reliance on because the biggest thing that really matters is consumer habits. And guess what? That is very tough to make assumptions on. You have no clue where consumer habits go. You have no clue what's going to be the next trendy thing. You've had stocks such as Crocs. I mean, we'll bring this up. Look at Crocs, for example. Do you see these big moments of when it erupts? That is when some of their products get super popular. And I guarantee you that if you go before these pops, no analyst was expecting them to grow at the rate that they grow, which is why these moves are so explosive, because no one expected them to maybe one year over the other have like a 300% increase in sales. And that's only because randomly some product line that they just created got super popular on some social media outlet, and now influencers are pushing it, and now everyone's hopping onto it. That is all super unpredictable. And inside the apparel space, you can't predict that. And it happens all the time, right? And then look what Crocs ends up doing after this initial exposure. Really has gone nowhere over the last 4 years now. Still looking better than Nike right now, but if you were a big believer, right? I mean, look at this. You also would have had dead money for 10 years between 2010 to basically 2019. Very tough to make these assumptions, which is why, again, looking at these numbers, which everyone loves to share on YouTube and on Twitter and say this or that, there's no edge there. Everyone has access to it, and the biggest edge is actually knowing what consumers will do next, and that's impossible to really know. But we could look at some simple stuff here, right? Let's try and see if their move of Nike simply not bouncing is warranted. Okay, well, number one thing that sticks out here, there is no revenue growth, right? So this right here shows us quarter over quarter revenue growth, pretty much it flatlined over the last 3 years. Okay, there's no revenue over revenue. There's no quarter over quarter revenue growth, right? Here maybe a few moments, but for the most part, I mean, last year was really tough on them. For the most part, they're not doing that great. Okay, so revenue has flatlined. Okay, so they're not growing as a company, at least in terms of sales. This is how net income looks like for them. So we did have this explosion post-COVID, but this is trailing 12 months, by the way. So here we can see how it's steadily growing, and then there was a major dip here for some reason. Obviously, this is net income, so there could be some like one-time events affecting this. But then it's been trending lower, right? Look at this. Last 2 years, just net income trending lower. So sales are trending lower. Net income has been trending lower. What about the PE? What has the PE ratio done since then? So early 2012, we can see that Nike traded at around a 17, 18 PE. And this is when they were growing. We just looked at this chart, right? We saw, actually here, we actually can see earnings growing. You see this EPS? We can see earnings per share is growing, okay? And it's growing, and the market is assigning a PE ratio of around 17, maybe low 20s during this growth period, okay, that Nike is having, right? Early on, it was like in the high teens and then in the low 20s. Okay, Nike stopped growing. Its earnings stopped growing around here. PE was all the way at 33, okay? So no more growth is happening. PE is 50% higher than what it was when there was actual growth, okay? Now we've been dropping. Where is it? Earnings are dropping at this point, right? So this is even worse, okay? Now we've seen revenue actually flatline, but now earnings are dropping. PE is skyrocketing, right? So actually that's pretty much telling us that the stock is not dropping quickly enough to make up for the fact that earnings are dropping so aggressively. And now it's finally starting to catch up, right? It finally started to catch up this year. And we're trading at a 19 PE. So earnings are still dropping for the most part. I mean, we see here that EPS went up for that last quarter that was reported there. But still, overall picture, it's still been dropping. I think the most recent report pretty much showed flatlining. It's still been dropping, and we're still trading at high teens. And we haven't even proven to the market yet that there is actual growth here. While previously we proved to the market that we have growth and we were trading at high teens, low 20s. Now we're back here, right? High teens, low 20s, and we have no growth. Okay? So when people say it's a great value play, this is basic numbers we're looking at. Now you might say, well, what if they have so much more cash than before? Like, you have to consider that. No, like, sure, maybe the growth is worse, but maybe financially the company's doing way better. Okay? I mean, I don't want to spend too much time here. Let's just look at what their assets to liabilities is. Super simple, right? Growth of assets, growth of liabilities. Okay, let's go back to those early years. Okay, 2012 or so, right, that we were looking at. Okay, 2012. Look at their ratio here, right? This is their cash. These are their debts, short-term liabilities, pretty sure. Or is it all liabilities? Yeah, short-term obligations. Okay, look at their ratios here. Right, again, this is also back when their PE was in the high teens, low 20s, proving that they have growth of top line and bottom line. They also had a ratio here of about 3 on average, okay? Do you see this? Cash to debt, okay? Today, when the company is contracting, revenues are flatlined, earnings are dropping, they also have the worst ratio that they've had in some time. During COVID, there was 2 instances here actually where it might have been as bad. But for the most part, outside of those 2 quarters, it's been like 25 years. 25 years, okay? So even that is worse. You can't even point to the balance sheet and tell me, well, that looks way healthier than it looked like 15 years ago, so we deserve a higher multiple. We do not. And then if we do something simple, such as type in Nike stock on YouTube, right? A day ago, this video was posted, but Unrivaled Investing. He ends up labeling Nike as a deep value play. Okay, after analyzing everything, he labels it as a deep value play. The number 1 upvoted comment here is about a person buying Nike here at $39. So that is the most upvoted comment. This is also the most viewed video on YouTube about Nike stock that just came out after we had this recent drop. And I think it's pretty clear, even if you look at Twitter or different social medias, that a couple days ago when Nike did have that monumental drop, pushing it, to new lows, people were saying, oh, this is like the newest low in like 12 years or something. That's all over social media. Everybody's seeing that, right? So the most layman investor out there, the one that barely puts money into the market or barely is an active investor, is seeing these headlines. It's being covered by CNBC. Everyone is seeing this. And because it's a household brand that everybody knows of, right? Everybody knows Nike. What do you think a lot of these people are doing when they see all these headlines saying that, oh, the stock is new lows? Here's your chance to buy Nike at the price that it was 12 years ago. And then you have the most popular video on YouTube telling you that it's a deep value. And then you have talking heads on Twitter telling you the same thing, right? Because again, people love the idea of like, oh, this is a discount. The stock is on a discount, ignoring that everything has changed about the company ever since it was at its peak. So we see all that happening. So what are the chances that while all that's being shoved in your face, that social media is reminding you about what a great value this is? What are the chances that this is the bottom, the actual bottom, that after 4 years of the stock going down, that the stock market is so kind that it's going to remind you and other people that, hey, this is the time to get in. Out of all other moments, we're going to publicize it. We're going to have all these headline pieces on YouTube and on Twitter to remind everybody that this is now the bottom to get it. What are the chances? Very slim. Most active investors, even professionals, let alone retail investors, underperform the market considerably when they are stock pickers. Okay? At the same time, they all tend to buy the same stuff. Okay? Because typically, stock picking and what stocks are popular, all that, people do it in crowds. People look and see what other people are doing online, what's being recommended, what people are talking about. So pretty much everybody starts buying the same stuff and starts underperforming in the same way. The word itself, outperform the market, to outperform the market, many have to also underperform. Or more importantly, to outperform the market, you have to be doing something different than everybody else, right? That's how it is, right? To outperform the market, you cannot be doing what everyone else is doing in the market. If everyone's reading the same headline pieces as you, and they are seeing that Nike's making these new lows, and that it's a great value play, and that they're pivoting, and that this and that, and you're going to get rewarded with buying the bottom, or it being shoved in your faces and your neighbors' faces, very unlikely. I did think personally that there was a chance for Nike to bottom, but for a different reason. So if I were to be a buyer of Nike, if you're someone that's looking to buy Nike, what I would want to see bad news hammering the stock day in and day after, until the point that the stock just stops going down. That's it. Right now, as it stands, the stock continuously, it gets affected by bad news. There was one moment which did get me long Nike. It did get me long Nike, and I will bring it up. It was right after their last earnings, right here, right? Oops, where is it? When was this report? This was in the evening of Tuesday. Now, this is only the cash session, but I remember that after they reported earnings, Nike stock went down right away. Earnings were bad. Immediate reaction was lower. And then as they worked into the hours of the opening session, it began to get bid back up. You can see how it opens up here, even trades lower on the day before reversing higher. And it did this off the back of negative earnings. They were receiving downgrades during this time. So to me, this was an earnings failure, which is what this channel is based on. I did get along the stock, and I held on to the stock. And I ended up pretty much stopping myself out somewhere in this region, only because it stopped going anywhere. And there is such a thing as an opportunity cost. So that's why I got out of it. For my earning failure plays, usually it has to work right away. I should not be sitting in the stock waiting for it to have a move. If this was truly the bottom for Nike and it's finally bottoming of bad news, it should have just gone straight up. That's it. Simple as that. It should have broken out of this consolidation and just moved on out, like right through here. And that is it. Okay? That is what I was looking for, and that is not what we got. Instead, we got it trading in the dirt again and ended up getting out again in this region about $42 or so. Fortunately so, because the stock continued to trend lower. I would want to see that. Again, negative news hitting the tape. Let me see the stock react better than that news portrays. Okay? Let us see the stock go up. Let us get back in again. And if it trades back under that level, we get stopped out, we move on. But I'm not going to be looking to buy Nike off the back of positive news. The stock is in a mega downtrend, and it hasn't proven otherwise so far for us. And there is a chance, listen, I'm going to sit here and say this. Yes, there is a chance that maybe this somehow marks the bottom. Is all the sentiment out there insanely bullish? No. I mean, I see it. Some people say that, hey, Nike got too political, and because of that, no one's interested in it. So I do see that outcry. It's not like every single person is super bullish about it. That's not the case. But what I'm not in love with is the fact that there's too much attention on it. And Nike is up these last 2 days, right? So you might say, well, that is the bottom. Of course it is. But if anything, it actually shows me that there is still retail investors right now getting into the stock because of all the attention on it, and people are chasing it here. I wouldn't be surprised if it starts turning back lower after all these people load back into it. We pretty much had this little breakdown here, and now it's reversing out. If you're so interested in getting long this stock, okay, get long right here, right, that we're looking at, and then set a stop at $40, let's say, and that is it, and honor that stop, okay? If we break under that, then get out, because obviously that's not a false breakout. That's the only thing I would play here. In my opinion, these last 2 days, today and yesterday, that were up about 2-3%, this is still retail investors still trying to chase a stock, maybe some professional investors too, only because there's so much attention on it. I personally think that Nike will end up bottoming when there's way less attention on it, and when we do get that negative news, which might need to be lower. We saw from a valuation standpoint, it's nowhere near deep value territory. It can definitely go way lower. I think even just the small figures that I showed you guys, it pretty much shows you that, if anything, it's still trading rich compared to what it should be. I would say in general, if you're an investor trying to buy stocks that are beaten down and bet on turnaround, is very, very difficult compared to simply buying stocks that are dominating the markets that are doing well. Buying leaders in the market that maybe have had a temporary dip is a way better plan than trying to time a bottom of a stock, because the chances that you somehow nail it and the fact that there's an actual turnaround story is rare, right? You have people like trying to nail the bottom on Peloton. I mean, look at it, right? There's no bottom to nail, but people will look at a stock like Peloton and they'll say to themselves, yeah, like this is why would I not want to buy the stock here? It hasn't run up yet. It has to run up. It doesn't have to do anything. The stock can hang out here and keep getting diluted and go down to $1. The majority of stocks, believe it or not, in the market actually end up trending down to zero. That's actually the history of majority of stocks. They end up trending lower, lower, and lower. The reason why the overall market goes up is because there's new leaders in the market that end up carrying the market higher, S&P 500, right? But if there were not new companies entering the space, if there were not new innovators entering the space, the market wouldn't go higher. But it goes higher because there are new innovators, there are new companies that are pushing the market up higher. We've pretty much seen that for the last 2 years now of AI been a major driver for market returns. MAG stocks were a big driver. Unfortunately, I can't bring up the MAG ETF here, but earlier than that. But look at the MAG ETF here, right? This has like the MAG stocks in it. Nvidia is part of it, which is a chip stock here, but you could see that for the past, what is it now? Like, approaching a year now, it hasn't gone anywhere, right? So if you were in many of these MAG stocks, it hasn't gone anywhere. So this has not been lifting the market, mind you. Nvidia is part of this, okay? So it hasn't gone anywhere, but you look at the S&P since November and way higher, right? I mean, what are we talking about here? What are we talking about here? Let me see. Oops. You know, S&P is up 12%. So the MAX stocks haven't pushed the markets up higher. Other stocks have pushed it higher, right? The other leaders right now that are moving the markets up higher. So way better to kind of follow the leaders than trying to time and buy something that's just like melting down on the market like this. Sometimes it works out. Sometimes you do get a turnaround story. You know, maybe some of you are trying to catch something like Abercrombie. There we go. Let's take a look at them, right? So let's take a look at them. Same deal, right? Apparel space. They're very popular, especially I know when I was younger. You can see chopping around, right? Chopping around. Had a massive run up here. Look at this, from like $14 to $54, crashed, rallied back up there, crashed lower. Look at this, from like, if you were an investor from 2010 to essentially 2023, 12 years, you made no money. You made no money. And this brand is still popular till it's actually even more popular now. Its stock's also up. Still see plenty of stores, but you made zero. Okay? Imagine the opportunity cost of being here. And unfortunately, some of the shareholders got bailed out and the stock went up. But in many cases, it doesn't happen. But this is the best case scenario for Nike, that the stock sits for the next decade and maybe then has a rerun, 8 years from now. That's kind of what you're betting on, And even then, if you were a buyer, in 2021 here, again, sure, maybe you were lucky enough to buy at 15 and 16, but you're more like, you're probably buying at 41, at 50s also, and now the stock is at 106, doubled or tripled over the last like 4 or 5 years, which a lot of stuff has, right? This is the best case scenario that you have for Nike. But I'm just showing you my thoughts here on it. If you have any rebuttals, let me know in the comments below if you found some of my insight helpful. If you like this video, subscribe for more content similar to this. Other than that, thank you guys so much for watching. Till next time.